Hi, thanks so much for tuning in and happy summer to you. It is officially summer, and I couldn't be more excited to be here with you for our June edition of the VBI Advisors newsletter Q&A. This month's question is, realistically, what are LPs looking for? What is the likelihood of my getting capital from them? And I love this question because it is something that more than just sort of folks starting out have in common that they want to know. All LPs are looking for four things, or should I say they're looking for things that break down into these four buckets. Team and organization. They want to know that you have usually more than one partner, largely so that you have the capacity to deploy the capital that you're trying to raise, and that you're going to be pretty organized and things won't fall through the cracks in terms of administration or operations. Track record, that you have experience and that you're actually just a very good investor. Strategy, they're looking for that strategy to be differentiated. How are you standing out in the market? 4, fund economics, also known as alignment of incentives between you and the limited partner. The more you have of these things, the more likely you are to raise capital. Like I said, in terms of team, 2 or more partners is generally going to be better than one, largely because if you as a solo GP are hit by a bus, they have to figure out how they're going to recover their capital. And they also want to know, like I said, that you have capacity for administration, for operations, for reporting, and it's totally fine to outsource what you can of these things as well. In terms of track record, the longer the better, unfortunately, and this does tend to be a sticky issue for emerging managers. There is a such thing as analogous experience. What experience do you have in the industry, in the asset class that you have done before that you could apply to the work that you're trying to do now? And not so much trying to just build on experience, make sure it's really successful experience. Of course, everyone wants to be top quartile and not everyone can, but make it as good as it could possibly be. Strategy should be one that is understandable, one that's actually related to the deals in your track record, and like I said, differentiated. There are a lot of jump offs out there, just another middle market buyout fund, and emerging managers actually can't really afford to go that route, largely because there's just so many, and there's just not a way to differentiate yourself. And then finally, in terms of fund economics, you want to have fees and carry that's appropriate for the size of your fund. Generally that 2 and 20, unless you're a very small venture fund where you can get away with a 2.5% fee, because you would need to pay your bills with a smaller pool of capital, based on a smaller pool of capital. I would venture not asking for more than 20% carry unless you're essentially a household name at that point. It's just otherwise LPs will wonder if your experience is actually analogous to what you're asking them for. I would say that unfortunately funding is never actually guaranteed. This is a business of people, and people can be very, very unpredictable. So remember that LPs are people. They are trying to make the best decision they can with what information they have. So be sure to give them more information and more reason to say yes rather than less. But know that you are completely and totally sufficient as you are going through this process. And that is our June Q&A. Thank you so much for tuning in. The Q&As will be taking a little bit of a pause for summer break, but we'll still have the newsletter. So feel free to email, send in your questions. Would love to hear from you, and we will see you again soon. Have a great summer.